Now, as we kick off segment 5, we wanted to flip it around. So typically we start with China and then go to the other areas. And here we wanted to start with India, because when you look at India, they recently reported their inflation numbers, and you get an idea. Now, for those that have been following us, we said that we were going to get a big surge in inflation. If you remember, we were saying that it was going to be about 7%. That was kind of where some of the things were starting to come through when you look at energy, when you look at food. But here you can see that we blew through the highs that we saw in 19, that we saw in 20, and we came in at about 7.8, 7.9%, depending on kind of what metric we're using. And it's why the central bank is going to have to be active. They're going to have to do things, because this is a huge shift. You can see that the inflation target range is between 2 and 6%, which means that the RBI's inflation target is about 4%. And it's almost double that. And based on where food prices are, where diesel prices are, where inflation is sitting in the country, it's unlikely we're going to get a huge drop off. They're going to try to cap it and not let it get much above 8%. But how are you going to invest in India? How can you invest in something where the uncertainty continues to be so high? The surge in inflation again was widespread. Obviously it came at 7.8%. But there was not a single bucket that didn't see a big increase in price by at least 1% or more, which is when you start looking at cereal production, milk and products, vegetables, fats and oils, which fats and oils continues to be, again, that's where they get a lot of it is imported from Russia. And the issues remain with fuel and lighting. As we look at just where crude prices are, where diesel prices are, we don't see fuel getting any better. As clothing, when you look at cotton, shortages in cotton in general, again, all of this continues to be an underlying problem, which is then when you shift to core CPI came in at 6.4%, and then the RBI measure of core CPI came in at 7.2%. So that 7% continues to be the underlying issue with housing, clothing, fuel. There was a broad move higher, and the only way to get in front of that is to increase rates. But the issue right now, India is still running a deficit. So if you're running a deficit, you have inflation starting to really ramp up. You have rates coming under pressure. Well, the U.S. 10-year is going up. You price off the U.S. 10-year. Your inflation is going up at a massive rate. You're running a deficit. Well, in order for me to invest in your country, I'm going to demand a bigger increase in XYZ, which is why we see their interest expense continuing to move higher. But when we start looking at the Reserve Bank of India's repurchasing rate, we do expect this to continue to move up more aggressively, as they try to counter a lot of these inflationary pressures. They're going to try to get in front of it, and that's going to slow monetary policy considerably. And as monetary policy slows, we see India slowing overall. Not a surprise. Again, they're still going to achieve growth, but it's just not the growth that's expected, which is when we start looking at global GDP and how the IMF has pulled back their estimates. They still have things growing, but when you look at what's happening in China, in India, a lot of these key growth markets, that's where we see a lot of the pressure to the estimates that are currently floating around for investors. Then when you look at, just in general, the good exports index. So when you look at the EM as an aggregate, it's still positive, but slowing. And that's the pressure. In Korea, South Korea is obviously still is still very strong, but they're typically a leading indicator for exports and for the global trade market, because a lot of things, they import semi-finished goods, export finished goods, export semi-finished goods to be assembled into finished products. So they're a key linchpin for end markets and middle markets. And as they slow, typically they're a leading indicator, and you're starting to see that come down. But if EM slows, that means what's going to happen to India, what's going to happen to China. And as we talked about in the EIA show, Fujairah, and especially on the heavy distillate resid side, are showing and really highlighting just how slow the shipping market is, given how they're not finding buyers for a lot of these movements. So then when you shift back to China and you look at credit, because you keep seeing like, oh, China's gonna lend, they're gonna stimulate, but credit supply isn't the issue. Like there's more than enough credit out there. There's more than any company and whatnot who wants credit in China can get it. They don't have a demand for it. And that's the problem, is either the rates are too high, the leverage at the company is too high, and they're just not willing to take on that additional credit. And because of those concerns, the banks aren't willing to bring down their rates. And that's when you look at the PBOC, which has really kept rates fairly firm, and they haven't been as, I think, dovish as the market has expected, because they're still trying to pull liquidity out. They're still trying to manage this as things continue to get much worse due to these lockdowns. China manufacturing PMI was expected at 47.3, came in at 47.4. And remember, back to the segment 1, we talked about how there was still inventory and manufacturing was still moving along. And you could see it was slightly negative. And here you can see there was contraction, but they were able to maintain some of that. Now, when you look at the Caxton China manufacturing PMI, much bigger drop. Expectation was for 47, came in at 46. The longer this prolonged and the lockdown continues, it's not that it's going to get much worse. It's just not going to recover. You're not going to get this sharp snapback like we had. You're going to get a little bit more of like a 2019 view where things kind of bump along the bottom, and you're just going to see this contraction and this slowdown, which again makes their GDP estimate target much harder to actually hit. Which is then when you start looking at, well, the weakness, when you start looking at weakness in currencies, the yen weakness is adding to inflation within Japan. It's not just one area, because you have the US dollar continuing to go up, which is putting pressure on spending, which is putting pressure on emerging and even developed markets, because they rely so heavily on the US dollar. And this is putting, again, sending CPI higher, sending that inflationary movement. And we'll talk about more in a minute why that's hitting Japan significantly. And the reason why we talk about Japan, because as their product slows, they're also a big buyer of products from China, and not so much products because they're going to be consumed there, but that middle market where semi-finished goods go from China to Japan, get put into the final component and shipped out. But new orders in China are falling through a floor, coming in at 43. Now, new orders are not getting much better. We're starting to see that crack elsewhere outside of China, which is why we talked about Korea. We're starting to see the leading indicators showing that pressure mounting. And then the non-manufacturing PMI was expected at 46, came in at 41.9. And that's not surprising when you look at the different things going up. We've seen pictures of razor wire and all types of barricades keeping people stuck. And that, again, is going to keep that well off of, in a contractionary standpoint. And that's why it's longer delivery times, not surprising, for everything of non-manufacturing and manufacturing is in the 30s. And as long as lockdowns remain, as long as checkpoints are there, this is going to continue to be an underlying problem, which is going to keep retail sales declining, keep retail sales soft when you look at just where things are and the inability of people to spend. Plus, employment in China is negative. You have new orders are negative. You have a hit on retail sales, and if people aren't getting paid, if people can't make money, they're gonna hoard. And you've already seen a big increase in the Chinese savings rate. And given the uncertainty around the COVID policy and what happens, nobody's gonna, even if when you come out of that, it was already a savings mentality within China, as it is across a lot of Asian nations, and this is only going to reinforce a lot of those concerns. Which is when you start looking at China PMI, manufacturing and services, you continue to see a lot of these underlying pressure points. Now, when you look at China medium and long-term consumer loans, you can see borrowing continues to fall. They've already tapped out the consumer as the borrower of last resort, which is why when you look at the retail sales, real estate getting hit so hard, that hits the Chinese consumer the hardest, because a huge amount of this additional debt or loans that happened between 2012 and 2016 was against the real estate market. So as those prices come off, as those values drop, your marginal propensity to consume will also fall because your net worth is falling. And if your net worth is falling, you're not gonna be able to borrow as much. You're gonna have to meet margin calls, and that's gonna again shrink a lot of that underlying spending. Which is why when you start looking at services, services was expected at 40, came in at 36.2, but incoming new business is in the 30s. So you're seeing new businesses fall. You're seeing the consumption fall. So if current businesses can't get the consumer to come in, how are you going to have a new business? How are you going to expand your business? Which is why, again, that shrinking aspect, and to be clear, this was happening pre-COVID. This was happening post the initial lockdown in 2020. So this is just making a bad situation worse, which I think is the crux of what we're trying to look at. Now, China's fixed asset investment in infrastructure and real estate. So real estate continues to fall. Infrastructure had that bounce. But again, there's that disconnect. You saw that 12.2% number. But then when you look at the satellite data, when you look at the movements, when you look at steel production, when you look at nothing followed that trend. So again, how much of that it was paper oriented versus physically put into the market, which is when you start looking at more Chinese households intend to save. So they're looking to save versus invest because they've already invested. 60 to 65% of their net worth is generated from real estate, and you're seeing real estate get hit. So how am I going to invest more? So I'm going to have to save to cover my total losses. And then once lockdowns end, people are going to look at that. It's like, well, you've put me into a lockdown, a hard COVID zero policy twice in 2 years. And I had to rely on savings. I had to rely on things. So I'm not going to be all that quick to spend because I may need some of this. I may need some of these different pieces, not only to cover my rising cost, but also to cover any type of hiccup. And that's when you start looking at, well, they're not going to be very active in buying real estate assets because one, they've already purchased them. Two, prices have come down, but they're underwater on some of these others, so they can't leverage them. Or they've already leveraged that real estate entity, whether that be land or home, to buy another one. So that's when you start looking at plan to buy a house in the next 3 months continues to fall in general. And this is just looking at Korea in general, as a whole. So exports, again, still strong, just slowing. And that's what I'm trying to say is, it's still growth. We're still growing. It's just not at the rate that is there. And then as China continues to worsen, Japan continues to worsen, other emerging markets, developed markets, that's where we see this more pressure on the manufacturing side and underlying export front. Now, India 8 core industries continued to go up on the output side, but then when you start factoring in inflation and pressure and put that into real terms, things continue to get a bit concerning. And that's when you start looking at global India service business activity came back positive. We expect that to fall again. And then the ASEAN manufacturing PMI went back up, but based on the Korean leading indicators, we expect that to drop. Still stay in expansion though, because again, you still need to replace China, and they're going to use the ASEAN nations to do so. So you'll see that remain robust. Now, the China foreign exchange. So as you look at the movement in dollars, so going back to the ASEAN nations, they still have to purchase dollars. They still have to do different things, but they're going to bring in, they're going to bring in extra dollars because they'll have a positive trade balance. Because if you can't buy from China, then you're going to buy from other areas, which will bring in and flow in dollars through normal trade. So they'll have to buy less. But if you're not buying it, but then China, who is trying to stimulate their economy, trying to create backstops, seeing their exports fall, well, they need more dollars and they need more things to protect their currency. So they're continuously whittling down their foreign exchange reserves. And as trade slows further, and they try to stimulate more, this will accelerate to the downside, putting more pressure on inflation, putting more pressure on their economy. And you can see how they're all interlinked. And that's what we try to get across in all of our different shows, is how interlinked everything is. There's not one thing that is just one entity that is a one problem. It continues to be an ongoing component. So when you look at employment, and as we've been saying, even before COVID, you can see that manufacturing PMI employment was negative. It's been negative since 2016. Non-manufacturing PMI, it's been negative since 2017. You've continued to see employment dropping in China pre-COVID. So this is only going to exacerbate the issue, especially as we talked about in segment 2. More and more U.S. companies are looking to diversify supply chains. They're looking to diversify locations, and a lot of them have assets in China, and they're going to look abroad and continue to shift different things. So then when you look at emerging market currency index, well, as the dollar strengthens, this weakens, which is going to exasperate what we talked about in segment 1, their leverage, their ability to borrow. And that's why we expect subsidies to fall. We expect spending to fall, and that compression continue to hash out. So now when you start looking at Japan, here's where they have inflation once again. The expectation was for 0.6, came in at 0.8. Cash earnings, still came in fairly strong, but again, that will start to roll off because that was for March. And then when you look at inflation for April, that will weigh on what actual cash earnings look like. All the while, just as an example of somebody who is benefiting from the fall in Chinese exports, Thailand exports continues to go up. Obviously, this is in dollars. So, but to be clear, volume and value both went up as people and corporations look to pull away from the Chinese markets. And then another thing that's continuing is China PPI. So the survey was for 7.8%, but the actual came in at 8%. So the cost is going up, and that has to get passed on. So when you think about Japan buying from China, the US, South Korea, ASEAN nations in terms of semi-finished goods, raw materials, that's where, again, we see this flatlining in PPI and then another increase in PPI, which is going to put more pressure on those export prices, which, again, is going to show up in everybody's underlying cost of goods. The weaker trade, both export and imports, were basically flat from March out of China, and that continues to be an issue as Korean exports to China fell in April for the first drop since late 2020, which is just showing, again, that Chinese demand drop. But it's also going to put pressure on Korea, but it's also showing the weakness that's in China. So you can see how it works on both sides of that balance sheet. And all the while, Chinese crude steel production continues to fall, with Chinese housing starts also falling as well. Changes in funding continue to drop from a high base, and we just, again, don't see that changing because there's just no demand and no willpower or ability to really stimulate. So then when you look at price pressures are broad-based, you have to look at other areas because this is just looking at where things are, and transport continues to be a big piece of it. This is not just Australia. This is not just ASEAN. This is not just China, India, or developed markets. Diesel, gasoline, MGO, marine gas oil, continue to be a huge amount of that cost pressure that is going to feed through and into the supply chain, which the U.S. is going to continuously import because we import all of those prices. Which is why when you look at China's property market signs of improvement and loans to real estate developers, housing market, mortgages, you're starting to see things flatline. But then when you see there was another company that came out and said that they're going to miss payments, I think it was Sunchi, and Evergrande continues to be a problem. So we are far from over. We're not even at we're still at the beginning stage of this devaluation on this pressure. So yes, it may stop going down with the support of the PBOC. The PBOC and the CCP have told banks, you have to lend, you have to give some of these, allow these guys to roll debt, you have to issue them credit. And that's, again, that's just gonna stop things from going down. No one says you have to increase the amount. You just have to make it available, but you don't have to make it easy, nor do you have to go higher and again, allow them to expand. So again, you'll see the flat line. We just don't expect the pop. And here's some of the reasons on why. When you look at China's CPI, the expectation was for 1.8%, came in at 2.1%, and it's not surprising. A lot of it was based on food. Grains went up 2.7%. Vegetables went up double digits. You're seeing a huge shift in food, which is why they continue to buy from us, the U.S., the Latin America in general. And as we see more and more of the tightness in the global market, you're seeing, again, food become a huge issue, not just for the emerging markets that are not the second largest economies in the world, but it's hitting everybody, and it's hitting hard, especially for the consumer. So this will put pressure on sales. This will put pressure on so many different things, which is why we continue to see an underlying problem in the global market. So that's what we have for you today. I apologize for this being a bit longer. We were trying to condense 2 economy shows into one. Hopefully it made sense. If you have any questions, again, you can find me on the YouTube comment section or on Twitter, and we appreciate your support. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.